All right, let's get right into it. Today, I'm putting on my skeptical equity research analyst hat. We're bypassing the mainstream media hype to conduct a rigorous, strictly data-driven explainer of ATI's Q2 earnings. Think of this as an investigative deep dive into the financial statements. We're ripping open the 10K, the 10Q, and the historical data to uncover the actual financial health of this company. No hype, just the hard data.
Before we go any further, please note this exact compliance disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, let's get to work.
Here's our roadmap for today. We'll kick things off with our ultimate valuation gauntlet, then dig into the media blackout, uncovering both the hidden red flags and the overlooked green ones. After that, we'll run a reality check using the methods of investing legends, and finally, synthesize ATI's economic moat for our final verdict.
Part 1, the ultimate valuation gauntlet. Look at this glaring contrast in the headline numbers. While revenue surged 11% to $1.26 billion and EPS jumped over 55%, adjusted free cash flow actually dropped 26% year over year. When we apply our Group A models, like a standard discounted cash flow using their weighted average cost of capital, we land at an intrinsic value range around $165 to $185 per share. But wait, when we run the unlevered free cash flow and free cash flow to the firm models, that valuation gets dragged down closer to $150. Why? Because the actual cash available to shareholders, the free cash flow to equity, is getting squeezed hard by intense capital expenditures and working capital needs. Now, the adjusted present value, which factors in tax shields from their debt, does keep the base case slightly elevated, but the core cash flow story, it is definitely way tighter than that flashy net income suggests.
Moving on to multiples and income models. The market is currently pricing ATI at a massive premium, trailing PE ratio of 67.44. Now, standard dividend discount models yield zero here since ATI doesn't pay a dividend. However, applying a residual income model and economic value added logic where we measure operating profit against a capital charge shows ATI is finally creating real shareholder wealth. But when we run a comparable company analysis against sector peers, ATI's EV to EBITDA and EV to sales multiples sit well above historical averages. Basically, the market is demanding absolute perfection in their future growth to justify this 67x multiple.
Looking at the balance sheet models, their net debt to EBITDA is sitting at a very healthy 1.5x, but standard book value and net asset value place the intrinsic value significantly below the current trading price, and fire sale liquidation value even lower. But here's the catch. Replacement cost is a massive factor here. Rebuilding ATI's titanium and nickel furnaces today would cost an absolute fortune, which offers a very solid floor. Finally, applying real options valuation using Black-Scholes logic on their growth projects, like that major Mexico expansion, adds a serious premium to the valuation, reflecting the huge potential of their $4.4 billion backlog. Part 2, Media Blackout, Red Flags. The headlines loved the strongest quarter since 2007 narrative, but as an investigative analyst, I found some deep red flags buried in the fine print.
First, earnings growth simply isn't translating to immediate cash. Free cash flow conversion dropped 26% while net income jumped 50%. You won't hear that on the news because cash flow statements are just too complex for a 10-second soundbite. Second, inventory swelled to a massive $1.67 billion, a detail buried deep in the balance sheet. Third, they're projecting a $200 million working capital cash drain for 2026. That conveniently doesn't fit the record margins narrative. And fourth, executive selling. CEO Kim Fields executed massive insider sales in June and July totaling over $24 million. The media usually glosses over these 10b5-1 sales because they totally contradict the bullish corporate tone.
Red flag number 5 is what I call manufactured margins. Stripping out a $9.9 million one-time real estate gain reveals that operational margins were slightly flattered. Headlines skip this because, let's face it, finding it requires actually reading the footnote reconciliations. Number 6, rising costs and revised qualification requirements at the New Mexico facility are dragging down HPMC segment margins, too operational for snappy news. And finally, that valuation ceiling. Trading at roughly 67 times trailing PE leaves literally zero room for execution errors. Wall Street cheerleaders ignore this because growth stories absolutely hate value-based reality checks.
Part 3, media blackout, green flags. We have to be objective, so let's flip the script. The footnotes also reveal 7 massive green flags, proving a structural transformation. Green flag number 1, rapid backlog conversion. They're sitting on a record $4.4 billion backlog, and a massive 70% of it is converting to revenue within 12 months. Forward-looking metrics lack immediate shock value, so they rarely make the evening news. Second, margin transformation in the AA&S segment is structurally expanding to 23.7%, showing it's no longer just a cyclical business. Third, a defense explosion. Defense sales in that segment grew an astonishing 90% year-over-year, completely overshadowed by commercial jet engine headlines. Fourth, unyielding pricing power. Their long-term agreements have built-in escalators driving structural gains. You just don't read about this because B2B contract mechanics are considered way too boring. Fifth, fortified liquidity. They paid off their 2027 notes, leaving 0 scheduled debt maturities until October 2029. Debt maturity schedules don't generate clicks, right? Sixth, a massive geopolitical moat. China's export limits on exotic metals like hafnium are directly boosting ATI's market share, a complex dynamic lost in typical market recaps. And seventh, naval nuclear dominance. A new contract literally doubled revenue for that program. This massive win is usually just lumped into a generic defense bucket by reporters. When you add all this up, the long-term cash generation engine looks absolutely formidable.
Part 4, Legendary Investors Reality Check. Let's apply the exact methodologies of the investing greats to today's price.
Let's start with Ben Graham, the pioneer of value investing. He calculates his Graham number using earnings and book value per share, and he would reject ATI immediately. That trailing PE of 67 aggressively violates his strict rule of buying companies with a PE under 15, and the price is nowhere near the net current asset value. To Graham, the price simply does not offer a deep margin of safety. He'd walk away without a second thought. Peter Lynch, on the other hand, might actually like this setup. Following his growth at a reasonable price methodology, Lynch loves a good turnaround story. If we calculate his PEG ratio by dividing the 67x PE by the explosive 56% GAAP EPS growth, we get a PEG ratio near 1.2. Applying the Lynch fair value model, this makes the growth relatively reasonably priced, assuming, of course, that massive 70% backlog conversion happens perfectly over the next year.
Warren Buffett would likely give a mixed verdict. He would absolutely praise the wide aerospace and defense moat, the high switching costs, and the safe 1.5x debt ratio. However, Buffett focuses intensely on owner's earnings, which is net income plus depreciation minus maintenance CapEx. He would heavily scrutinize the declining free cash flow conversion and the high capital expenditure requirements for those new furnaces. Basically, he'd love the business quality but definitely balk at the price-to-cash flow ratio.
Part 5, Moat and Final Verdict. Time to synthesize all 21 models, the 14 media blackout flags, and the legendary investor perspectives. First, a quick refresher on the moat. An economic moat is a sustainable competitive advantage that allows a company to generate strong returns on capital for an extended period. Morningstar categorizes these into intangibles, switching costs, network effect, cost advantage, and efficient scale. For ATI, their economic moat is undeniably wide, and crucially, it is expanding over the next 3 years. This is driven heavily by high switching costs. Aerospace and nuclear qualification processes take years to complete, meaning once ATI is in, they are incredibly hard to replace. It's also driven by intangibles. They are one of only 3 Western producers of highly engineered exotic metals like hafnium. That geopolitical advantage I mentioned earlier is expanding this moat every single day.
So what's the final verdict? Based on the average of our 21 analytical models, from DCFs to real options, ATI stock is currently fairly valued to slightly overvalued. While that 56% EPS growth is spectacular, the models highlight a hefty 67x PE and declining near-term free cash flow. Bottom line, the market is already priced in the flawless execution of that $4.4 billion backlog.
The earnings growth models and the expanding geopolitical moat are pointing to the moon. But those hidden cash flow red flags, the $200 million working capital drain, and the insider selling suggest a potential storm is brewing. The numbers are violently pulling in 2 different directions. So which side of the trade are you on? Take these frameworks, dig into the filings, and do your own homework.